Stop looking at the stock market. The real war isn't being fought with tariffs or tweets. It's being executed in the silent back-end channels of global finance. Channels you never see. Here's the contradiction. The US dollar is the strongest it's been in decades. It is the undisputed king. And yet, for over 15 years, a strategic campaign has been underway to build the instruments for its eventual dethronement. Not through confrontation, but through infrastructure. China isn't trying to beat the dollar on the headlines. It is methodically building the plumbing to bypass it entirely. This is the rolling top. The peak of a system is not a moment of collapse, but a period of maximum stability. The precise time when the incentives to build a rival network become irresistible. The old order looks healthiest, just as the new one is being bolted together beneath the floor. You are told to watch the price of the yuan, the level of the Shanghai index. That is the magician's flourish, distracting you from the mechanism being assembled behind the curtain. The quiet danger is not a crash. It is irrelevance. It is the slow, certain shift from a single, dominant highway to a world of alternative routes. And the danger wasn't in the price, it was underneath it. Welcome to the wealth timeline, where money, power, and history quietly shape the world around us. The question, then, is what drives a nation to attempt rewiring the foundational circuitry of the global economy? Picture the trading floor of a major global bank in London or Singapore any day in the early 2000s. A payment instruction to settle a multi-million-dollar oil transaction between, say, a South Korean refinery and a Saudi producer is initiated. That instruction does not travel directly. It routes through a correspondent bank in New York. It settles in US dollars. It is ultimately subject to US regulatory oversight and legal jurisdiction. This was, and largely remains, the core mechanism. The US dollar as the dominant vehicle currency, New York and London as its clearing hubs, a network called the Eurodollar system, so vast and liquid it became synonymous with global finance itself. It was a system of immense convenience and profound structural power. For a nation like China, which by the mid-2000s was deeply integrated into global trade, it was the only game in town. At the time, this looked stable. What no one questioned was the structure holding it up, or what would happen if a major participant decided to start building their own foundation. The impetus was not dominance, but vulnerability. The year is 2009. The global financial crisis is in its aftermath. Chinese policymakers, holders of the world's largest stash of US Treasury securities, watch as the Federal Reserve embarks on quantitative easing. They see a fundamental truth. The issuer of the world's reserve currency can engage in massive monetary expansion to stabilize its domestic economy, with global inflationary consequences borne by all dollar holders. Their primary strategic pressure was one of existential financial risk. As documented in academic papers and policy speeches from figures like Zhou Xiaochuan, then governor of the People's Bank of China, the concern was the Triffin dilemma, the inherent conflict where the currency-issuing country's domestic needs ultimately undermine its currency's global stability. The assumption, clearly held, was that the US-centric system was inherently unstable for a large trade surplus nation like China. Their wealth was stored in a system they did not control, subject to the policy whims of a geopolitical counterpart. The response was logical, not aggressive. The goal was internationalization, to make the renminbi a usable currency for trade and investment, thereby reducing reliance on the dollar. It was a defensive maneuver. It worked, but only under conditions that would not last. What followed was a phased, pragmatic build-out of an alternative ecosystem. Each step delivered real benefits and created an unintended consequence. Phase 1. Trade settlement. Starting in 2009, China promoted the use of the renminbi for settling cross-border trade. For Chinese importers, this meant cheaper costs and less exchange rate risk. For trading partners, it offered access to a vast market. The side effect was subtle. It began creating pools of offshore yuan liquidity in hubs like Hong Kong, the genesis of a parallel money market. Phase 2. The swap network. The People's Bank of China began signing bilateral local currency swap agreements with other central banks, from South Korea to Argentina to the United Kingdom. These were framed as facilities to promote trade and financial stability. The legitimacy was clear. These were official central bank-to-central bank tools. The deferred risk? Each swap line was a potential off-ramp from the dollar in a crisis, a backstop that reduced the need to seek Fed swap lines. Phase 3. Financial infrastructure. In 2015, China launched the Cross-Border Interbank Payment System, CIPS. Western observers largely dismissed it as a redundant clone of SWIFT. That was a misreading. CIPS was not a SWIFT killer, it was a settlement system for yuan transactions. Its purpose was to provide a Chinese-operated clearinghouse, reducing transaction times and, critically, creating a piece of sovereign plumbing. Through this period, China's financial markets appeared to be liberalizing. Foreign investment flows increased. Prices in many assets were improving. But a dual narrative was unfolding. Prices were improving. The plumbing was changing. The stronger it became, the harder it was to stop. The first fissures were not seismic events. They were institutional realizations, ignored or rationalized away. 2015. China experiences a sharp capital outflow and a managed devaluation of the yuan. Global markets panic over the price. They miss the institutional move. China begins tightening capital controls and actively manages its cross-border payment systems to stem the flow. It was a demonstration of administrative control over the new plumbing they were building. 2016. The International Monetary Fund includes the renminbi in the basket of currencies that make up the special drawing right, SDR. This was a technical acknowledgement of its use in global trade and finance, granting it a seal of institutional legitimacy. The signal of a maturing, usable currency was clear, yet it was largely filed away as a symbolic victory. 2018. The Trump administration employs secondary sanctions, threatening to cut off from the dollar system any non-US bank that did business with blacklisted Iranian entities. This was a stark legal demonstration of dollar power. The reaction in finance ministries worldwide was not public outrage, but quiet, sober calculation. The policy made perfect sense from a US perspective. The unintended consequence was that it framed dollar access as a privilege that could be revoked, not a neutral economic utility. The system's surface, global equity markets, dollar strength remained firm. Nothing collapsed, and that was the problem. The gradual deterioration of absolute dollar dependence was a process, not an event, making it easy to miss from within the momentum of the existing system. The inflection arrived not from an East Asian policy paper, but from a European capital. February 2022. Following the Russian invasion of Ukraine, the US, EU, UK, and Canada announced an unprecedented measure. They will freeze the assets of the Central Bank of the Russian Federation, held within their jurisdictions. This action immobilized roughly half of Russia's $640 billion in foreign reserves. The decision-makers were Western allies, acting in concert. Their reasoning was clear, legally grounded, and represented a new frontier in non-kinetic statecraft. It was a reasonable, forceful response to a grave geopolitical breach. Its effect on the global financial architecture, however, was categorical. It redefined the very nature of a reserve asset. A reserve is, by definition, a risk-free store of value accessible in times of stress. This action proved that assets held within a political and legal jurisdiction could be made inaccessible by the rulers of that jurisdiction. For every other nation, not in a formal military alliance with the West, the calculus shifted overnight. Diversification of reserves was no longer a financial optimization strategy. It became a strategic imperative for national security. Gold purchases by central banks surged. Discussions about holding reserves in non-traditional currencies or in neutral locations accelerated from theoretical to operational. The move was a necessary tool within its context. But from this point on, the outcome was no longer optional. The incentive structure for the global holding of dollar-denominated assets had been permanently altered. The consequences of this decades-long process are not about the end of the dollar, but the redistribution of financial autonomy. Who benefited? Nations and entities seeking strategic hedging gained options. Commodity exporters like Saudi Arabia gained negotiating leverage by discussing yuan-priced oil contracts. Nations facing U.S. sanctions pressure, like Russia, found a partially built alternative network to facilitate trade. China itself gained a measure of insulation and a reduction in its dollar funding risk, a key vulnerability. Who absorbed the cost? The incumbent system absorbed the cost in the form of eroded exclusivity. The dollar's network effect, its deepest moat, faces gradual dilution. The ability to conduct unilateral financial sanction becomes more complex and costly as alternatives, however imperfect, exist. How did power shift? Financially, power is diffusing from the center to nodes. The renminbi's share of global payments remains modest, but its share of global trade financing and central bank reserves has grown meaningfully. Institutionally, the IMF's SDR basket is more representative, and forums like the BRICS New Development Bank create parallel lending institutions. Structurally, the world is moving from a unipolar financial system to a multipolar or multi-network system. Power now resides not just in who issues the currency, but in who controls the clearing rails, defines the messaging standards, and offers the legal safe harbor. The shift is one of optionality, not replacement. For the professional viewer, this history is not a prediction of 2030. It is a framework for understanding the present. We are navigating a rolling top in the post-Bretton Woods II era. On the surface, FX rates, equity valuations, will exhibit volatility based on cyclical factors. But the underlying tectonic plates, the composition of reserve assets, the hierarchy of payment systems, are in a state of slow, persistent reconfiguration. This is the core distinction. Prices are the headline. Plumbing is the story. Consider the yield curve. Its inversion is a classic signal of market expectation for lower future growth and central bank policy shifts. It's an inversion. When short-term rates fall below long-term rates again, is often misread as an all clear. In this new context, it can also signal a structural shift in the plumbing, a recognition that the old centralized dollar funding model is under stress, leading to a permanent repricing of long-term risk premia and a new equilibrium in global capital allocation. The late cycle psychology here is not greed or fear, but complacency. The belief that the foundational rules of the game are immutable. The strategic response is not forecasting which currency will win, but adjusting one's risk posture, understanding counterparty exposure, the jurisdictional risk of assets, and the resilience of supply chains to financial friction. History doesn't repeat events. It repeats incentives. The incentive to build redundancy, to seek autonomy, and to mitigate jurisdictional risk is now powerfully entrenched in the institutional mindset. Your first takeaway is systemic. All financial architectures are contingent. They are built on a set of political agreements, economic efficiencies, and security guarantees. When those foundations evolve, the architecture adapts, first invisibly in the plumbing and later visibly in price. Your second is behavioral. In periods of structural transition, the greatest error is conflating liquidity with solvency and stability with permanence. Risk management becomes less about predicting the next crisis and more about understanding the changing topology of the system itself, its new channels, its new friction points, its new centers of gravity. This is not a call for alarm, but for acuity. It is an argument for looking past the screen of prices to study the blueprint of the building. If this helps you see the system more clearly, subscribe to the Wealth Timeline, because the next story won't predict the future. It will help you recognize it